So while everyone's cramming into the S&P 500 right now, they're going to at best get 5-8% before the end of the year, whereas in the small caps, and it's already started to move a lot, but they could probably double or triple that and be in a very good position by skating to where the puck's going versus where it's already been, looking through the rearview mirror.
How should investors be positioned in light of the recent FOMC decision to hike by 25 basis points? We're here to discuss this with hedge fund manager Thomas Hayes. He is a managing member of Great Hill Capital. You can also follow his writings at Hedge Fund Tips on Twitter and hedgefundtips.com. A great thread. You should check it out. Thank you very much for joining us today. Thomas, good to see you.
Thanks for having me, David. Great to be back.
Before we talk about your outlook, I just want to ask you, I'm curious, did you make any outsized bids and trades before the FOMC decision today in anticipation of any surprises?
No, we stayed long and strong. And as you know, we were one of the few handful of bullish strategists since last fall when everyone was saying we were going to go down another 20% after we were already down 25, 27%. We were saying pound the table, buy. At that point, what there was to buy was semiconductors and tech, which were the most hated. They led the first 5 months of this year. They've been a monster trade. And now as we move into the back half, there's a new group that's going to lead the back half of the year. And I'm sure we'll talk about that in a few minutes.
Yeah, excellent. The dollar's down slightly today. Risk assets, the Nasdaq's flat, the S&P 500 is flat, slightly down. Markets aren't moving much, so not a lot of surprises. Were you surprised by anything that Fed Chair Powell said today?
No, you had to expect, we came in hot into this meeting. I think a lot of the bears were hopeful that Powell would give them an opportunity to buy stocks because they've missed a 30% move off the lows. But he really didn't do anything other than what was expected, which was give the rate hike, say we're going to remain data dependent. Every meeting is live until it's not. We've got 4 more bits of major information, 2 employment reports, 2 major inflation reports. And what he's effectively saying for those people who study the data is that the inflation numbers, due to continued base effects and owner's equivalent rent, are going to be weak, just like we saw this month. And that should give them enough cover. The thing that's interesting is they did actually have ample cover to skip this month if they wanted to do. He's got in his mind that he's afraid of being Arthur Burns from the 1970s, but the conditions today relative to the 1970s are nothing alike. And I think that's honestly the big risk moving forward, is that he miscalculates, he overplays his hand, and he snatches defeat from the jaws of victory. However, that's the bad news. The good news is you got Bullard coming off, going into academia. He's a major hawk, and you got Goolsbee starting to have a bigger voice, who is a dove. And I think that the data is going to be supportive enough as it was this month to skip this month, but certainly by September, they'll not just have 1 3 handle on headline, but they'll have 2 or 3 and maybe a possible 2 handle, which will give them cover. I mean, they just wouldn't be justified to continue with another hike if we came in even with headline. They could turn to core, but in the 2s, it would be ridiculous to risk putting a lot of people out of work just for his ego not to be the next Arthur Burns.
Somebody did ask him at the meeting whether or not his policy was restrictive enough. He kept alluding to the fact that the economy is strong, jobs market is resilient. Well, if everything's going great, Thomas, wouldn't it, this is a question posed to Jerome Powell, if everything's going great, wouldn't it logically make sense that inflation might have the risk of ticking back up if policy were not even more restrictive?
Well, there's 2 things that he can do. One is to stop and move backward. The other is to stop and keep things elevated. And I think you've got quantitative tightening happening in the background with the reduction of the balance sheet that many people forget about because they're not actively talking about that as much. But number 2, and the thing that he could do, which would enable him to have a monster victory, is stop hiking in September, but keep rates elevated for a long time. And if he does it right and he doesn't get too aggressive, he could have a situation like 95 to 2000 where the Fed funds rate was just about 6% for 4 or 5 years, and they kept it elevated and growth continued for another 4 or 5 years. So that's how they have to play it. But if they choke it off too soon, that's problematic. I think with the next 4 major data points, though, they'll have no justification to hike again. They'll continue to talk hawkish, and they'll continue to skip all the way to the bank.
So let's talk forward guidance then. The CME Fed Watch tool as we speak right now, as of market close on Wednesday, it's anticipating a 77% chance of no hike by September, and even an overwhelming probability of no hike by December. Do you share that consensus?
I do. I think he's done. I think that the data will in no way give him any justification to do another hike by September. And on that basis, he can continue to talk hawkish in order to maintain long-term inflation expectations, so that people's behavior does not change in the short term, which would cause a reacceleration. So the data will give him cover. He won't have to hike in September, but he should continue to talk hawkish to keep those 5-year inflation expectations pinned in the low twos, where is their target. And the other thing they have to keep in mind, the debt service has become increasingly larger due to the hikes. And on that basis, he really can't afford to hike much more. So he's got kind of balanced two different things: $1 trillion of interest expense and a little bit above trend inflation. If you look back to post-World War II, the way we got out of 120% debt to GDP was letting inflation run hot and inflating our way out of it. Inflation ran 3 to 5% for 4 or 5 years following 1948, and debt to GDP collapsed from 120% to 63%. And I think that's the playbook they need to follow moving forward.
Okay, so given your outlook on the Fed funds rate, what's your outlook for the short term and long term of the yield curve?
Well, I think the biggest surprise for the second half of this year, and where all of my focus is on, is that there is going to be an unexpected rally in the 10-year bond. If you look at the commitments of traders, which is an important measure that we look at very carefully, it works differently for different instruments. But when it comes to 10-year bonds, you can look and see that the commercials have been aggressively getting long for the last couple of months. They always are early and they always are right. I think in the back half of the year, what no one's expecting is that the 10-year is going to get bid, and that's going to have a huge impact on this rotation moving forward. The two key themes for the second half of this year, in our view, are US dollar continues to be soft and weaken. And number two is the 10-year bond gets bid, which compresses yields, which has a positive impact in terms of mortgages, in terms of banks, in terms of REITs, and in terms of the rotation into small caps, which the largest sector, of course, 21%, is financials and small banks.
If bonds get bid, are the markets then assuming or forecasting softness in economic growth, or the other way around?
I think two things. I think the other way around in part, but number two, keep in mind that the problem with the regional banks in March was in part a mark to market, because they had longer duration. In the case of SBD, it was 5.7 years. In some of the other banks, it's longer. So as the 10-year gets bid, they're going to have mark to market improvements. Same with their loans are going to get bid, and that's going to enable them to put more capital to work and re-accelerate lending, because they no longer have capital constraints as their portfolios and as their balance sheets look a lot better as the 10-year yield gets bid. So I think that's something to keep a close eye on, because if there's been a few areas that few people have been paying attention to up until the most recent 5 or 6 weeks, small caps, regional banks, REITs. Okay, we've had a pretty big trade on that since the mini financial crisis in Vornado, which was the most hated sector of the market in March or April. Commercial real estate, everyone said it was the end of the world. We said properties in New York City, it's never the end of the world. We're very interested. These are trading at a 40% discount to book. And now those are up 40, 50% in the last few months. That was the most hated trade. Now it's just getting started, by the way. So there's a lot to do in REITs. There's a lot to do in small caps and bank rotation. And then if you look at dollar week, what are you seeing today? You're seeing the exact antithesis of the first half. Banks are up, small caps are up, and China is up. Emerging markets are up. And what's down? Dollar's down. 10-year yield is down. Tech is down, and semiconductors are down. And I think that persists. Now, this rotation, David, it doesn't mean tech is going to crash and NVIDIA is going to crash and Microsoft's going to crash, although Microsoft's down 4.5% today. it means that they so dramatically outperformed in the first half of the year. It's possible we could see them underperform in the second half of the year. It doesn't mean they have to crash. It doesn't even mean they have to pull back. You could just see everything else start to work really well, like the groups we're talking about, and they perform less well. Now, because of their weighting in the index, that means the indices are going to perform less well, even though there will be plenty of stocks and opportunities under the surface that could be up 30, 50, 70% in the second half, while maybe the indices are only up 5 to 8% after being up 18% in the first half, year to date kind of situation. So in the context of the interest rates getting the 10-year getting bid, we talked about what to do there. In the context of weak dollar, the opportunities are in multinationals that get more than 50% of their revenues from abroad. Very few people have the dollar weakness baked into their second half estimates. You have emerging markets in China will be an incredible opportunity. We're already seeing a bid there with the Politburo meeting and signaling massive stimulus in the second half. And then finally, with risk on, I think biotech is going to be a place that's been kind of doing nothing for 12 months. It's modestly up off of its last May lows, but there's going to be great opportunity there as well.
When you use the word underperformance, are you referring to underperformance relative to the first quarter or underperformance relative to other assets and sectors?
Both. I think both. So I would look at it in context of certainly underperformance relative to the monster first half of the year. Certainly underperformance relative to the sectors that money is starting to rotate into as the rally broadens. And general underperformance, there will be some of these long duration mega cap techs that could be flat for the end of the year. And I'm not saying all of them, and I wouldn't make that bet, and I certainly wouldn't be shorting any of them, but I wouldn't be adding new money to kind of the Magnificent Seven at these levels. I'd be probably holding some of what I have, maybe trimming in some cases, but making sure I have a lot of exposure to where the puck is going.
I keep hearing that tech is one of the sectors that are most sensitive to interest rates, especially higher rates. Is there any truth to that? And if so, can we expect a major pullback? I know we talked about a minor correction because of the things you talked about, but because of restrictive policy, can we expect a major pullback?
I think that's a misnomer that's unsupported by data. And particularly if you look at data going back more than 5 minutes. And I'm speaking generally now because this is kind of a maxim in the market. This is not something that you just invented. This is what everyone's saying, and you're absolutely spot on. But let's just take a look back beyond the last 5 minutes and look back to the late 90s when you had the biggest tech rally in the history of the NASDAQ from 95 to 99/early 2000. And you had the Fed funds rate just about 6 to 6.1%, and it stayed elevated for much of that 5-year period. And yet you saw the continued growth because of why? The advent of a new industry, i.e. the internet, which was going to increase productivity and change the world. And the answer to the question is, did it change the world? Unequivocally, it changed the world. But, when there's excess pricing in the benefits for decades to come all at once, that's why we saw the pullback in 2001 and 2002. I think as it relates to AI, a similar type of narrative, it's always a little bit different. And I think there will be some companies that get far too much credit and they'll crash. But I think this time the leaders, they're highly cash generative companies that are established. We're not betting on eyeballs. We're not betting on promises. We're basically making bets on profits. In some cases, we're giving multiple expansion and a little bit of re-rating to the upside, but not seeing the level of excess that is prevalent when you're really at the peak of a bubble. I think this is kind of starting, and I think Microsoft did a decent job tempering expectations yesterday, saying, hey, the demand for compute and generative AI is unlimited, but there's going to be some costs for us rolling it out. Our CapEx is going up. And it's kind of this nuanced, perfect balance where people expect good things, but they're grounded in reality. And I think that's very healthy. And that gives us a longer term runway as we look at risk assets.
How do you respond to the argument that risk assets overall, and especially the tech sector, are overvalued, valuations are overstretched, and the risk-reward profile just isn't there right now to be long?
I tend to agree to a point in terms of our earlier thesis that they will underperform relative to what didn't work in the first 5 months of the year. Small caps, banks, REITs, some of these other groups, some industrials, some healthcare, et cetera, that are playing catch up. As it relates to the general market, though, it's very interesting what's happening this time, David. One of the data points I look at besides commitments of traders is the Bank of America Global Fund Manager Survey. And it's so interesting. You would have thought this month, a survey that just came out a few days ago, that sentiment would have been through the roof, like you're starting to see with retail investors, the AAII sentiment survey and the bullish percent, et cetera. Institutional managers, they remain bearish. They're bearish at the levels, their sentiment, their growth expectations are below COVID levels, and they're at great financial crisis lows. These are levels you see at bottoms, not on tops, which is mind-boggling. The other thing that's very, very interesting about this cycle is very similar to the COVID lows in March of 2020. Who do you think bought the lows in March of 2020? Who was smart enough to buy, Exxon when it was trading at $30 and Wells Fargo when it was trading at half a book? And all of that and ride the first 5 months of the rallies? Was it the institutions who were smart and said these valuations are too low? Or was it the quote unquote dumb money, the retail traders? And it's counterintuitive, but you know who got it right and who got it wrong? The retail trader got it right. They were the most exposed for the massive part of the rally from March, April through June, July of 2020 and then beyond. Institutions didn't start catching up until most of the rally was already in the rearview mirror by the end of 2020, first and second quarter of 2021. And then we know what happened in the beginning of 2022. Once they were all in the boat, they pulled the trap door opened and they were toast. The exact same thing is happening this time around since October. All of the quote unquote dumb money has been buying this rally and they're up 30% off the lows, give or take. And the institutions are still skeptical. As a matter of fact, there was another data point. They said, what level of risk do you think you're currently taking in investment? It was the lowest level since March or April of 2009, the great financial crisis lows. After the market was rallying, they were missing the whole thing once again. So history is repeating here. The retail investors are getting it right against the ahead of the institutions, and the institutions are going to desperately play catch up. They're not going to play catch up buying, Meta up 250% or Nvidia up monstrous or Microsoft. They're going to buy all these groups that failed to participate in the first 5 months of the year, and they're going to ride those up for monster gains into year end so they get to keep their jobs.
Well, have you seen any data for retail sentiment and positioning right now?
It's exuberant, okay? And the thing is, where everyone gets faked out is in the first move off the heart attack collapse, which we saw in basically October, November of last year. Indicators get overbought pretty quickly. And right now they're overbought across a wide spectrum. And retail sentiment is getting towards the extreme of bullishness and exuberance. And in ordinary conditions, after the market's been trading sideways for a couple of years, at those levels, you benefit from taking the other side of the trade, taking the other side of the exuberance. The problem is in the first move off the heart attack low, what gets overbought has a tendency to stay overbought. And what I like to say is stay pinned for a while until everyone is in the boat. And what we know from institutional positioning and data is they're not all in the boat yet. And therefore we can push higher. And unlike most years where we'd be going into the fall with this level of kind of enthusiasm, I'd be looking for a 10, 12, 15% pullback in the fall and then a rally into year end. I think this time's going to be different. I think the 3 to 5% pullbacks that we may get in this volatile, softer period are going to be bought, and they're going to be bought aggressive by institutions who are underweight. So maybe some bumpiness, maybe some 3 to 5% pullbacks, but they'll be readily bought. And those praying for the 10 or 15% pullbacks because they didn't get positioned in October and November of last year are going to be sorely disappointed and left behind once again.
I've heard as high as 5,400 on the S&P by next year. Is that something that's likely, you think?
I think that's pretty high. I mean, we have to see earnings start to catch up. I mean, it's normal for the multiple to expand aggressively off the lows, and then the earnings numbers start to come up. I mean, we came into this earnings season with extremely low expectations, negative 7.1% earnings growth. Next quarter is supposed to be modestly positive, and then the fourth quarter is expected to be up 7.6%. So we need to see that guidance kick in and support the multiple expansion that we're starting to see. I got my mind on 4,800, I think is a reasonable level. Do we do it before the end of the year? I think that is probably a realistic outlook. And then looking into the election, so that would be another 10%, that would be another 12% next year. It's possible. I think it's pretty aggressive. I think if you got to that level, you'd have to be looking out to the end of next year and you have to see earnings start to support. But I don't think that's the game to play. I think those chasing the S&P up 30+% off the lows in October are going to be sorely disappointed because you're not going to get the 18% in the second half that you got in the first half. You might get mid-single digits. It'll be subdued. The leaders of the first half will be more underperformance, namely the Magnificent Seven, long duration big tech. But the opportunity, you can make monster money under the surface in the groups that didn't perform as well in the first 5 months. And in the second half, you're going to see stocks up 30, 50, 70%. And that's where you're going to make your money. So I'm less focused on 4,800 or 5,200. I could care less. I'm not betting on the indices. I'm looking at what's still left that's going to participate and going to move aggressively in the next 6 to 9 to 12 months.
Is there anything that could significantly change your positioning over the next 6 to 12 months? In other words, if you were to, go back to the drawing board and say, let's reposition everything, let's get more defensive, perhaps do the exact opposite of what you're doing now, what would need to happen, hypothetically?
I think if Powell did hike again in September, I would take a second look at everything that all of my core premises and start to look at what would be the lagged effect. It's kind of like, I think we're teetering on the edge. I think if he pushes it too much, we're going to go over. And if he pulls back just in time, we're going to live another day like nothing happened. Just some data on small caps. I know I've mentioned it a bunch of times, though. There have been 10 occurrences in the last 40 years where the trailing 1-year returns were negative for more than 6 months. That's the condition we're in right now. Actually, it's been 17 months, and that's only happened one time since 1982. The net effect is when you've had that happen, negative trailing 12-month for 6 months or more for small caps, the average forward 1-year return is plus 25%. So while everyone's cramming into the S&P 500 right now, they're going to, at best, get 5-8% before the end of the year, whereas in the small caps, and it's already started to move a lot, but they could probably double or triple that and be in a very good position by skating to where the puck's going versus where it's already been, looking through the rearview mirror.
Excellent. Well, where can people learn from you and look through not the rearview mirror, but look ahead, so to speak, and gain more from hedge fund tips?
Well, thank you. I mean, we have a website, hedgefundtips.com, but what's become very popular and the number one podcast in the hedge fund niche by FeedSpot. It's called Hedge Fund Tips with Tom Hayes, is our weekly podcast, videocast. You can search on youtube.com or just put it in Google and it will come up and you can listen to it or you can watch it. And people find that extremely valuable. It's free. And that's probably the best way to get to know us.
Well, congratulations on the success of that podcast. I'll definitely put a link in that description down below so people check it out. Thank you very much, Thomas, for your time. Appreciate it, and we'll speak again soon.
Thanks so much, David.
Thank you for watching. Don't forget to subscribe.